It's that time of year when many people want to know from economists what their expectations are for the following year, i.e. 2023 in this case. So here goes. I'm going to talk just briefly at a macro level, at a very high level, what my expectations are for overall property values in the commercial property space during 2023. Let's just look at recent history. We saw MSCI not so long ago release its half-yearly property market data. The all property average capital value per square meter, all commercial property classes together, showed an average capital value growth rate year on year of 8.4%, which is quite significant. Us economists like to adjust things into real terms. There's always an inflation illusion in the country because there's general inflation. So to see what really goes on, you need to adjust for that inflation rate and look at values in real terms, which I do using GDP inflation. And I found still there was a positive real growth rate of 3.9% year on year, which is quite significant in these times. The last time we'd seen any noticeable real capital value growth was back in 2015. Since then, in real terms, the values have been on the slide for most of this period. Nominal all-out value declines in 2020 and for a stage last year, but for the rest of the time before that, often a situation where you got very low actual capital value growth, not keeping up with inflation and correcting therefore over a few years in real terms. That often is how many property corrections take place, in real terms, but not necessarily in nominal terms. This is a long-term value correction, real value correction, to get back in line with economic fundamentals as they are today, I believe. This is the long-term picture for property values, why I believe further correction is essential, because our economic fundamentals that drove property values to very high levels by historic standards a decade or so ago were the pre-GFC years of 5% plus economic growth. Very strong economic fundamentals, and you saw from the 1990s up until that stage a few 100% inflation in average capital values. Real property values at that height no longer made sense, given that for over a decade now we've had this broad economic growth stagnation, many structural challenges coming home to bite, and as a result we struggle to grow by even 1 or 2% per year. It's a very changed economic environment, a very changed set of fundamentals, and so real property values over a long period are correcting to get more in line with those. That's what I believe is happening here. But there was this short, quick uptick in capital growth in real terms in the first half of this year, and people ask me the question, well, why can't this continue? And my answer is because that was a reflection of a recovery off a low base, out of a deep lockdown recession, the economy coming back partially, not to pre-2019 levels always, but coming back quite rapidly off a very low base as lockdowns eased. And with it, a lot of things spiked up, including capital values on property, very briefly. But what we've had since the beginning of the year is renewed economic pressures, which I think start to put additional pressure on the property market once again, going into 2023. What am I talking about? Well, since late last year, we've had interest rate hiking, 350 basis points worth of it by the SARB. That puts pressure on the economy as a whole because we've got high levels of debt in this economy. It also puts pressure on a very credit-dependent market such as the property market. And you would think it would dampen demand directly. But the fact that it also slows the economy and the fact that across the world, many central banks have been hiking interest rates because the inflation surge that they're trying to dampen was a global issue. It was driven by COVID supply chain disruptions for one, and then this year more concerns with energy supply disruptions driven by Russia boycotts and sanctions after the Ukraine invasion, and food price spikes across the world because of agricultural disruption related to the Ukraine. So we've had this surge in CPI inflation in South Africa. We've had surges in inflation across the world, interest rates going up. A lot of countries in the world talking about recession, and slowing global economy affects us too via trade and capital flows. So we've got this rising interest rate situation, slowing economic growth, 0.2% economic growth year on year in the second quarter after 2.7% in the first quarter. So we've slowed. And those have to, at some point, impact on the property market and property demand, I believe. Our broker surveys, our FNB property broker surveys, point to exactly that. Sales activity perceptions in the third quarter survey being off their earlier 2022 highs, rental market demand being off its earlier 2022 highs, and business confidence amongst brokers having declined significantly each quarter since the beginning of the year. So it looks like from the property related information, the property market's been slowing. TPM also points earlier this year to weakening tenant payment performance in the commercial property market. I think that those renewed negative economic pressures have started to impact on the demand supply situation in property and on the strength of tenants. And with a lag, as we head into 2023, I believe that takes capital value growth down again into low single digit territory underneath general inflation, and that we go back into that long-term correcting situation where you have low single-digit capital value growth, not keeping up with general inflation in the economy next year, and therefore real decline. And therefore, the long-term correction, which started back in 2016, continues for the foreseeable future. What can turn it around? Well, at some stage, we need to have the structural reforms, the structural policy reforms, fix the electricity supply, fix the infrastructure, invest more in infrastructure. It's a long story. These structural challenges are well documented, but meaningful structural reforms needs to happen in the coming years for this economy to start growing not by 1 or 2%, but by 3, 4, 5%. And then perhaps you could go into a more sustained period of capital growth in property, capital value growth in real terms on a sustained period.